begin by understanding what an asset is, and more importantly, the concept of human life value. An asset is a kind of property that yields value or a return. Now the big question is, how can an agent estimate the amount of loss when a person dies? For calculating this, we use a measure called human life value, which considers human life as a kind of property or an asset that earns income. HLV measures the value of human life based on an individual's expected net future earnings. Net earnings is the income a person expects to earn each year in the future, less the amount he would spend on self. We use a simple formula to calculate HLV, which is the annual income of a family divided by the interest rate that can be earned. Now let us learn how to calculate HLV with the help of an example. Mr. Rajan earns Rs 1,20,000 a year and spends Rs 24,000 on himself. What amount of insurance should an agent suggest to Mr. Rajan when the rate of interest is 8%? We know that the annual income is the amount earned minus the amount spent, which in this case is 1,20,000 minus 24,000, which equals to 96,000, which is the net earning. Now we divide it with the interest rate that can be earned, which is 8%. In general, we can say that the amount of insurance should be around 10 to 15 times one's annual income. Thank you. In this next video of the lesson, What Life Insurance Involves, you will learn about risk. Here we will be covering the basic overview of what risk is, the difference between life insurance and general insurance, and the nature of risk. We know that life insurance provides protection against those risk events that can destroy or diminish the value of human life as an asset. There are three kinds of situations in the life of an ordinary person where such loss can occur. Those include dying too early, living too long, and living with disability. Let us now look at the differences between life insurance and general insurance. Life insurance policies are contracts of assurance, while general insurance policies, with the exception of personal accident insurance, are usually contracts of indemnity. In case of life insurance, there is uncertainty about the event of death, while in case of general insurance, the risk event protected against is uncertain. Lastly, in case of life insurance, the probability of death increases with age, while in general insurance, in case of perils like fire or earthquake, the probability of the happening of the event does not increase with time. Mortality is related to age, and hence young people who are less likely to die are charged lower premiums as compared to older people. But people who are old but otherwise in good health tend to withdraw, while unhealthy members remain in the scheme. This posed a serious problem to the insurance industry, and as a result, they developed contracts whose premiums could be afforded and paid by individuals throughout their life. This led to the development of level premiums. Thank you. In this next video of the lesson, What Life Insurance Involves, you will learn about level premiums. Here we will understand what are level premiums and its components. The level premium is a premium fixed such that it does not increase with age but remains constant throughout the contract period. This means that premiums collected in early years would be more than the amount needed to cover death claims of those dying at these ages, while premiums collected in later years would be less than what is needed to meet claims of those dying at higher ages. This indicates that the excess premiums of earlier ages compensate for the deficit of premiums in later ages. Level premiums also suggest that life insurance contracts are for long terms, 10 years or more. Here are some important terms to remember. Reserve. The premiums collected in early years of the contract are held in trust by the insurance company for the benefit of its policyholders is called reserves. An insurance company keeps this reserve to meet the future obligations of the insurer. Life fund. The excess amount also creates a fund known as the life fund. Life insurers invest this fund and earn an interest. The level premium has two components. First is known as term or protection, which is the premium needed to pay the cost of risk. Second is the cash value element that constitutes the saving element. This means that almost all life insurance policies contain a mix of protection and savings. The more the cash value element in the premium, the more it is considered as a savings-oriented insurance policy. Thank you. In this next video of the lesson, What Life Insurance Involves, you will learn about the principle of pooling or mutuality. Here we will understand the principle of pooling and its various roles. Under mutuality or pooling, the funds of various individuals are combined. The fund flows from many sources to one. Mutuality or the pooling principle plays two specific kinds of roles in life insurance. The first is its role in providing protection against the economic loss arising as a result of one's untimely death. And second is that it helps in pooling and evening out of financial risk. It helps life insurer to manage financial risk. Through pooling, insurer is able to pay uniform rate of return across time. Thank you. In this last video of the lesson, What Life Insurance Involves, you will learn about life insurance contract. Here we will learn about advantages and disadvantages of savings insurance contracts. The final aspect of life insurance is the contract. Its significance comes from the term sum assured. This amount is contractually guaranteed, making life insurance a vehicle of financial security. The element of guarantee also implies that life insurance is subject to stringent regulation and strict supervision. The contracts involve both risk cover and a savings element. Life insurance, in fact, has been less a protection product and more a way of holding wealth. We must also note that pure term insurance, which provides only a death benefit, has a low premium. Now that we understand what is a life insurance contract, let us look at its advantages. First, it is a safe and secure investment. Its cash value guarantees a minimum rate of return, which may increase with contract duration. Second, regularity of premium payments calls for compulsory planning of one's savings and provides the discipline that savers require. Third, insurer takes care of investment management and frees the individual of this responsibility. Fourth, it provides liquidity. The insured can take a loan on or surrender the policy and thus convert it into cash. Fifth, both cash value type life insurance and annuities may enjoy some income tax advantages. And finally, it may be safe from creditors' claims, generally in an event of the insured's bankruptcy or death. Apart from these advantages, there are some disadvantages too of a life insurance contract. First, as an instrument with relatively stable returns, it is subjected to the corroding effect of inflation on all fixed income investments. Second, the high marketing and other initial costs of life insurance policies reduces the amount of money accumulated in earlier years. And third, the yield, while guaranteed, may be less than that on other financial market instruments. Lower yield is the result of a trade-off which also reduces the risk. Here is a quick look at the topics covered in this chapter. Thank you.